Hi everyone, thanks for joining. We'll just give it a moment or so before we make a start. Appreciate people will be moving on from previous calls, but thank you for joining the session. And as I say, we shall make a start in a couple moments' time. Great. Okay, I can see the numbers are going up quite quickly now with people hopping on from previous calls. Hi everyone, thank you so much for joining. Good morning, good afternoon, good evening from the various locations that we have represented across the panel and across the audience today. We're really excited to be having this conversation. We are joined by a fantastic panel of leaders across the global virtual asset space, and we have a lot to cover in a slightly short period of time. So I'll keep my introduction relatively short on that basis. Just a small bit of housekeeping, please add any questions that you have throughout the conversation into the Q&A box. And if we have time at the top of the conversation, we'll make sure we come back to them for the panelists to discuss. The session will be recorded, so you will be sent the link to access that recording following the session. And we welcome, as I say, any questions in the chat box throughout the conversation. Just notice there is a slight echo potentially. Could any of the panelists, are they hearing that echo? Just to check if it's my...
No.
Okay.
No.
Okay, Nicholas, it may be your side, but if anybody else in the audience is hearing that, please do flag and let me know, and I'll see if I can, thank you, do anything about that during the call. So as mentioned, we are really delighted to be hosting this discussion today. It's an opportunity to explore the upcoming African chapter of the Global Digital Finance, Global Stablecoins Regulatory Playbook, which we'll hear a little bit more about. And this chapter has been co-authored by a collaborative working group across AIR, CGAP, and the MIT Digital Currency Initiative. We've engaged with peer review colleagues from a range of representation across the ecosystem, so academia, industry, and regulatory backgrounds. And this process has provided a really diverse range of perspectives and experiences into the content that we're really looking forward to publishing. So the paper will be officially launched next week at the 3i Summit in Ghana, where we will be hosting with our colleagues at CGAP a roundtable discussion to celebrate the official publication. And for those that are in the audience today that are also attending the summit, please do let us know, as we'd love to see you in person and hear your feedback live on the day. So all attendees that are on the session today will receive an update as soon as the paper's live. And again, we welcome your reflections on this discussion document. But the purpose of the conversation that we have across the panel is really to explore key considerations across African markets in relation to virtual asset service providers, and specifically stablecoins and their regulatory approach. So as mentioned, we're joined by a really brilliant panel of leaders representing a range of diverse experiences, perspectives, and organizations who you'll hear introductions from in a couple of moments. But first, I would like to welcome John Apache, founder of Markets Evolution and executive residence and board member at Global Digital Finance, to set the scene on the Global Digital Finance, Global Stablecoins Regulatory Playbook. We can maybe abbreviate that with GDF now that we've introduced you, Jonna, to make that less of a tongue twister. But really just to start highlighting some of the key findings, the insights, and the particular areas of relevance within that publication as we look forward to the forthcoming publication of the African market assessment of that work. So over to you, Jonna.
Thanks so much, Lauren. And it's lovely to be here today and to be supporting AIR in the launch, the pre-launch of the Africa chapter of this playbook. For those of you who don't know us, GDF is a global non-profit association of member firms, and we offer an open innovation platform for advocating and accelerating the adoption of best practices for digital assets. So our mission is to promote and underpin the greater adoption adoption of market standards for the use of crypto and digital assets through the development of best practices and governance standards. And we do this by creating a shared engagement forum in which industry, policymakers, regulators, and academia can engage. Obviously, this is a huge undertaking. We have a range of policy and regulatory programs, working groups. We provide consultation responses and roundtable discussions with regulators, and have some technical programs as well to explore the practical sides of implementation, such as industry sandboxes. And we can't do this without our network of partners and expert collaborators, including AIR now. So about the playbook, the playbook really came from a realization that we have a challenge that's now unavoidable. Stablecoins are inherently global, but the regulatory frameworks that we have to govern them remain largely jurisdiction bound and jurisdiction specific. And fragmentation is no longer just a theoretical risk. It's something that is impacting adoption of stable coins, and it's a real and growing constraint on scale, trust, and cross-border functionality, which, as many of you will know, is one of the key use cases for stable coins. So we developed this work in collaboration with GDF stablecoin issuer members, based on ongoing dialogue with regulators across multiple jurisdictions. And the purpose of the playbook is really, rather than proposing a single global framework, which would not be practicable, it sets out a shared set of principles and common concepts for fiat-backed, fiat-referenced stablecoin issuer regulation, which focus on a few key areas. So we focus on topics such as reserve asset quality and liquidity, segregation and bankruptcy remoteness of reserves, disclosures and attestations, redemption mechanics, governance, operational resilience, and AML and CFT. And what we want to do here, by breaking these down into blocks and providing the terminology, is try to create a common regulatory vocabulary for stablecoins so that we can reduce confusion around terms like, what does it mean to be fully backed? What does redemption at par and on demand actually mean? When we talk about HQLA for stablecoins, what are we talking about specifically? Is this the same HQLA that we think about in our banking prudential frameworks, for example? And if not, why not? What is the concept of systemic versus non-systemic, and why do we have to consider systemic and non-systemic regimes differently, potentially in different markets? So on the whole, we intend for this to be a practical way for regulators to assess functional equivalence across different regulatory frameworks, even where the legal form differs, and to therefore be able to use this as a means of breaking down some of the barriers in discussing cross-border usage of stablecoins in practice, such as, through the development of mutual recognition frameworks, even unilateral recognition for some jurisdictions, through the development of equivalence, although that's always an ambitious one to aim for and generally not what people think it is, and to move the whole conversation away from these fragmented and jurisdiction-specific debates back towards those first principles and common terminology. And one of the things that we realized while we were working on the playbook, and while we were having conversations with regulators as well, particularly, even in the development of the UK, where I'm based, our regulatory framework with respect to stablecoins, is that a lot of our assumptions about stablecoin regulation and what best practices are inherently based on assumptions about how US dollar stablecoins work in practice. And these are tied to the very specific nuances of US dollar markets, of US dollar behavior, and of the US Treasury markets, for the US Treasuries that mostly back these instruments. And these assumptions cannot necessarily be transferred to other jurisdictions. Assumptions around liquidity, for example, or even in some cases stability, these do not necessarily hold even in jurisdictions like the UK. US Treasury markets are unique globally in being uniquely liquid and deep. And that's what indeed makes them such lubricants of the global financial system engine, really. But obviously, there is a need for and a demand for non-dollar stable coins, and that's what we need to turn to next. Most jurisdictions are realizing that the benefits of stable coins cannot be fully realized until we have non-dollar stable coins that are locally issued and locally regulated in the jurisdictions in which they're most going to be used at scale. And those need to also have the ability to interact with stablecoins in other jurisdictions in order to truly realize those cross-border benefits as well. And in order to do that, we need to start looking at some of the regional specific challenges around stablecoin regulation and the issues that arise in different regions, where there might be commonalities, but also where there might be regional specific considerations. And that's why we were delighted when AIR offered to produce the Africa chapter of the Global Stablecoin Regulatory Framework Playbook, which really happy to say, is such, I think, a great reflection of the reality on the ground faced by many African jurisdictions, the questions that regulators are facing at this critical point in time. And it's also a really realistic and pragmatic look at those questions as well. When it comes to stablecoins, as many regulators have found out through painful trial and error, they're not a thing that you can wish away or regulate away. And so while there needs to be an acceptance of the reality of stablecoins in issuance at the moment, and the fact that most of those are currently US dollar stablecoins, there also needs to be a clear path forward in ensuring future monetary and economic sovereignty through locally denominated, locally issued stablecoins as well in multi-currencies. So on that note, I think that's a nice segue into more on the Africa chapter of the playbook itself. Really looking forward to the discussion today, and it's been a real pleasure supporting AIR in producing this chapter.
Thanks so much, Jana. And as you said, the publication has been a real hive mind discussion that we've had with our co-authors across CGAP and the MIT DCI, but importantly also with the diverse representation across the continent, and acknowledging that those functional baseline principles really open up that dialogue to be had across the continent, but very, very importantly, regionally and in country, to assess the different needs of the different markets across Africa as we explored those principles. So it's been a really fascinating process. And as mentioned, we have a very exciting panel lined up today to represent various elements of that diversity in perspective. So with that, I will invite my fellow panelists to come in and give a quick introduction on their name, their organisation, role, and relevance to the topic of discussion today. So just going around the screen, maybe Haosung, I can invite you in first to give a quick introduction, if that's okay.
Thank you. Good morning, good afternoon, good evening. It's a pleasure to share this panel with my fellow speakers. I'm the policy lead at CGAP, and for those of you who may not know CGAP very well, we're a global think tank focused on financial inclusion, or inclusive finance rather, sitting at the World Bank. And I lead the policy work overall, and we do a lot of work on leveraging technology, data to advance the frontier of financial services. So, and before joining the CGAP, I was also working very closely with the policymakers and both at the global level, global engagement, and at the country level, advising emerging market country authorities in approaching policy issues on a range of issues. And with that, I think I'll stop here and looking forward to the discussion. Over.
Thanks, Haosung. And Tahiru, inviting you in.
All right. Thank you very much, Lauren. I'm glad to share this stage with my colleague panelists as well. I'm currently with the Virtual Asset Department at Bank of Ghana. My specialization or my focus include virtual asset, stablecoins, and fintech innovation. So I've played a very key role in the development of a regulatory framework for virtual asset tokenization, and as well as taking part in CBDC pilot. So prior to joining the virtual asset department, I was with the Fintech and Innovation Office, now a department, where my primary focus was on oversight over regulated licensed fintechs, which in Ghana are basically for now payment service providers and dedicated electronic money issuers. Thank you. I look forward to a great discussion.
Fantastic. Thank you. And Jack?
Hi, everyone. Pleasure to be on the call. My name is Jack. I'm part of the Nairobi International Financial Center Authority, which is a state department under the National Treasury and the Ministry of Finance. I lead on innovation there. My background is in VCP. I used to be in startups and I'm a founder. And then I joined the NIFC, launched it a few years ago. And since then, I've been part of the Virtual Asset Task Force, which created the Act for virtual assets in Kenya. And now we are currently working on the regs even today. So looking forward to the call.
Thanks, Jack. Will?
Hey, everybody. My name is Will. I'm currently a student at the Harvard Kennedy School studying public policy, predominantly in fintech, and I'm doing this collaboration through the MIT Media Lab's Digital Currency Initiative. So I come from a predominantly technology background, but have been working in the CBDC, tokenized deposit, stablecoin space for the past 5, almost 6 years now at this point. And kind of bring more of a technical and product kind of background to this paper. So very excited to have this panel.
Fantastic. Thanks, everyone. So, as I mentioned, we have a lot of content to cover in this time. And with that, I will move straight into the panel conversation. As noted, if there are any questions from the audience, please do feel free to use the question and answer feature throughout the session, and we will be moderating that as we go. So, Haosong, maybe I can turn to you first, if that's okay, as we've discussed and we've heard from Jonna, in terms of how the chapter is positioned and builds on those global principles that we've identified, but with that, the importance of assessing those principles in the local market reality that we see across the continent. So, drawing on your experience and your work in various emerging markets and developing economies, what makes the different market contexts across Africa distinct in practice when we consider applying these principles in reality?
Thank you, Lauren. As Jana mentioned, when looking at the African chapter, we didn't start from scratch. We have the principles in the Global Playbook as a useful starting point, and we also reference the recommendations and the guidance of international standard setting bodies. While at the same time, we also have the good reference points for various legal and regulatory framework issued by other jurisdictions. But we also apply these principles and the guidance in the context of Africa's economic and financial sector reality. Maybe let me highlight a few issues. First of all, starting from the goal of the chapter is really about the contextualized policy thinking. We're not giving specific prescriptions, but really looking at the economic and the financial sector realities and the policy choices that authorities will first need to consider. And then moving to the regulatory approaches that can help countries both benefit from the potential of stablecoins, while also ensuring that the risks are well understood and mitigated. So maybe let me highlight a few dimensions where context matters. First is about the economic reality, and the financial sector starting points are quite different in the continent. And we look at a large share of economic activities in Africa still informal, and many people and the small business lack adequate access to traditional financial services. We're talking about financial services beyond the basic transaction account access. And the pain points in the traditional finance are particularly acute in terms of high cost of financial services, for example, in particular in cross-border remittances. And the limited access to formal savings and credit. So in that context, we also looking at, the macro fundamentals and the liquidity constraints in the market. And we know many African countries face higher inflation, more volatile exchange rates, and the structural foreign exchange shortages. And this, first of all, create a strong demand side driver for dollar-denominated stablecoin, as Jana mentioned. And this is as a way of either to preserve value or to access cheaper financial services, in particular payment services cross-border. Now, so we understand that the demand side of drivers for adoption are there. We're really talking about whether people can move money affordably across border, pay suppliers, and protect their savings from erosion from inflation. And within that context, we also look at the digital payment landscape, which is also quite different. And we know Africa is already a global leader in mobile money and in many aspects of retail payment innovations. And the digital ecosystem is already quite diverse and dynamic, although across the border, there's a lack of interoperability and fragmentation in terms of the ecosystem. And despite, ongoing efforts for Pan-Africa payment system integration. So in that context, stablecoins are emerging in a quite pragmatic manner as an alternative rail for specific use cases in specific corridors or contexts, right? And adoption, as we mentioned, started with grassroots level adoption for US denominated stablecoin. This raised a set of both policy issues and regulatory concerns. On the policy side, we widely discuss, the risk of dollarization, the challenges in capital control management, and domestically weaker transmission of monetary policy, and the potential disintermediation from the banking sector if there's a mass adoption were to take place. Now, a lot of these issues are based on fundamentals. It's not specifically new, something that a stablecoin created, but because of the peer-to-peer transferability and because of the velocity of money moving, right, there's create a certain complexity in policy decisions. And then the regulatory concerns, we're talking about issuers residing offshore, and sometimes the reserve backing assets is also elsewhere, right? So this is a whole set of issues in terms of what regulatory levers authority have. And very often authorities tend to focus on the on and off ramps, domestic intermediaries, where really the stablecoin intersect with traditional financial systems and the fiat conversion channels. And then beyond that, there's also current discussion about the rationale for local currency stablecoin. And we really look very carefully at that, right? So the questions being asked is, are there viable use cases? And where do local currency stablecoin fit in the existing payment systems? And what are the implications, for example, competition with existing payment instruments such as e-money, right? If it's domestically used, and what risk might it bring to the broader financial system, because stablecoin don't operate in isolation, in the so-called crypto space, right? And the third, there are also important infrastructure gaps, and we're very clear about the legitimate needs, but then at the same time, looking at, in particular, the local currency stablecoin. We look at whether there are, despite the potentials for cheaper and faster cross-border payments, and we are also looking at the supporting infrastructure, for example, liquidity at the on and off ramp, robust custody, and clear redemption channels, right? So there's a various prudential stability, integrity, as well as consumer protection considerations. So in essence, we are looking at a phased, more proportionate approach to regulation. The first set of questions the authorities need to answer is really a nuanced understanding of the reality and the use cases. And then there are policy choices, as we discussed, and then going into a proportionate risk-based approach. First, bringing some of these key control points, such as exchanges, wallet providers, and payment service providers using stablecoin into a risk-based regulatory perimeter. And then from there, we can think about more comprehensive regimes as the market matures and the capacity grows. And then finally, I'll talk a little bit about institutional capacity and the regulatory resource constraints. I think the other speakers will come back to this point as well. And we talk about this programmatic approach, phased proportionate implementation, as well as regional and global coordination. I think through the African regional bodies, payment initiatives, and more broadly, the development community, the capacity building providers, we can support the authorities to have a nuanced understanding in the real use cases in the specific economic context, and then a phased approach to policymaking and regulation. Let me stop here. Thank you.
Thanks, Hao Song. Really helpful scene setting in terms of what we explore in the paper. And interestingly, as you've rightly started to outline, the highly dynamic nature of the digital finance ecosystem across various markets in Africa just add to the interesting nature of this kind of discussion and exploration that we capture throughout the paper. So against this backdrop, will, strong domestic payment systems across the continent, persistent cross-border frictions and opportunities presented by emerging payment opportunities really across the continent, and drawing that against a lot of the research that you've conducted in the DCI and also through the creation of this paper, where do we see stablecoins really delivering the most immediate real-world value in those use cases that Hao Song has begun to spell out across the continent today?
Yeah, I think that's a really good question. I would say probably the biggest real world use case right now is really in the remittance and kind of payment corridor kind of use case. This is again where the organic demand really started this entire kind of question of stablecoins in Africa. Obviously, African payment corridors have some of the highest remittance fees in the world, and so it is a natural kind of corollary to that. Stablecoins really did just find kind of a default market for that. Adding on top of that as well, just as an additional bonus, getting USD dollar access, which of course adds its own policy challenges on top of that. But the stability provided from holding stablecoins just provided another essentially pillar of access there, as well as the fact that they, at least historically, were relatively easy to set up and transfer with fairly minimal kind of oversight for peer-to-peer transfers. So there is kind of talk and discussion about what it could potentially look like in the more immediate future in terms of things like trade invoicing or even local currency stablecoins. I'll be honest and just say that hasn't quite materialized in terms of aggregate numbers just yet. That's kind of true for both the African context and for a lot of non-USD stablecoins more broadly. And so in some sense, we don't quite know how that will materialize, but for right now, I would say the really big use cases for stablecoins are still very much in the payment and FX remittance kind of space. So.
Great, thanks, Will. And Tahiru, Jack, I wonder if we could invite you in at this point in terms of how this kind of assessment aligns with your domestic realities. Are there different priority use cases emerging in your respective jurisdictions? What does that landscape look like for you both?
Right. Thank you very much. I pretty much the developments in the Ghanaian market also reflect exactly this kind of trends. So when you examine the major use case of stablecoins in Ghana today, is going to be more for store of value, remittance, or cross-border payment, settlement of cross-border payment. And I think these are some of the issues that we are trying to navigate carefully, because you want to be able to appreciate the net effect on the economy, right, or in delivering our mandate as a central bank. So if you take, for example, the FX effect that William has just highlighted, I think it's one of the major issues here. When based on these P2P transactions on various crypto platforms, you see that sometimes it serves as a parallel virtual asset, or crypto platforms literally serves as parallel FX market, because in a way it can become a benchmark for how the market deal with or respond to FX pricing and all that. So these are things that we are looking at carefully. We're hoping to a local currency backed stablecoin as well, but and considering the fact that there are quite still a lot of, or a number of unanswered, unresolved issues with regards to the overall impact, we are trying to adopt a sandbox approach, a sandbox first approach, especially with activities that are already with us. So, for example, the USD-backed stablecoins, the Tether coins, the USDT and USDC, they are quite so much circulating in the Ghanaian economy. So, how do we deal with the potential impact of that on FX, and maybe even wider implications, assuming that or considering that stablecoin has become the most dominant type of crypto asset used in the market. So if you consider all these things, we want to adopt a sandbox first approach, especially for issuers. But when it comes to those stablecoins that are already circulating in the market, our approach or our framework is looking to focus more on the intermediaries. That seems to be like the most realistic option, where intermediaries will be required or expected to do comprehensive due diligence before listing any tokens, where there is going to be ongoing reporting obligations, so that we appreciate the scale of the use of those tokens in the market, and to take appropriate regulatory interventions. Thank you.
Great, thanks, Tahiru. Jack, maybe I could welcome you in for a quick reflection on William's point, and then Tahiru, I'd love to come back on potentially some more on the sandbox, if that works.
Sure, thanks a lot, Lauren. I think as William, Tahiru, and Ren have mentioned, there are some challenges on the monetary policy side, the prudential side, as well as the consumer protection side, meaning that if our economy gets dollarized, it's a huge challenge for us. In terms of the NIFC, our mandate is to promote global competitiveness and also to increase foreign investment into the market. So our focus on the task force is to see how can we have the most globally competitive rates, the most globally competitive access points for international virtual asset service providers to land into Kenya and operate. So I can see both sides of the coin, and I sit right in the center. So I do agree with William in the sense that most use cases right now are for remittances. And also Taria's point that if we do let it open completely, there is a challenge for the local currencies. And as Ren mentioned, there's no use case right now as of yet for the local currency stablecoins until we develop that ecosystem further. So I think it's a triangulation of all issues, and I think collaboration is where to get us to the next point. Thank you.
Yeah, definitely, Jack. Thank you. That leads quite nicely. We've had a couple of questions in the chat as well around Tahiru, some of the points that you mentioned there of market engagement mechanisms. So we explore that quite extensively in the chapter itself in terms of opportunities and different roadmap approaches that could be taken by authorities leading in their development approach of thinking for regulatory decisions and policymaking approaches. But the Bank of Ghana, as you mentioned, has particularly leaned into this market engagement model throughout that process. Maybe you could talk to us a little bit more around your approach through sandboxing and also potentially the national literacy efforts that have been published recently and how that has shaped the regulatory thinking and policy direction on virtual assets in Ghana and for the team.
Right. Thank you very much, Lauren. So when it comes to engagements, like you rightly mentioned, I think this is one area that Bank of Ghana has done quite well. From the period of cautious stance, when we were literally cautioning the public against the use of, literally telling them that these kind of areas were not regulated under the Payment Systems Act. And so it was basically just like other economies. And from at a point, Bank of Ghana started engaging with the industry and practitioners, which actually led to our exposure draft in 2024. So this was basically exposing the bank's thinking around or its proposed regulatory measures around the evolving virtual asset activities in the country. It led to, and of course, the fintech framework has been with us for some time now, I think since 2021, but it was mostly focused on, obviously, non-virtual asset or non-crypto use cases, mostly fintech, payment, and other use cases. So last year, when we, alongside working to enact the law, so we now have the Virtual Asset Service Providers Act. Alongside, we undertook a beta test of our sandbox platform just to assess its readiness to support virtual asset use cases. Because this is something that we really needed to embark upon. And I think one of the key areas we're looking at was the ability to automate reporting. So to leverage API by the regulated entities or the virtual asset services to report, the regulatory returns and all that, all other forms of data required for regulatory supervision, for them to report that. And it turned out quite well. And today, when you look at our framework, there are two main sides to it. One is more pilot focused. So where we have admitted some 6 entities of diverse use cases into the regulatory sandbox, ostensibly to help shape the development of our directives or our virtual asset regulatory framework. I think I must mention that in developing our act, we adopted the principle-based approach, which basically means that the act itself is more of high-level provisions, and we definitely need some directives and guidelines in order to operationalize the act. So we are using what I call the sandbox pilot with the 6 entities that have been admitted to shape the development of the directives to make sure that the framework is fit for purpose and is relevant to the market context of Ghana. So that is one. The other aspect has to do with supporting ongoing innovation. So the Act has a schedule of virtual asset activities that require licensing or registration based on the risk profile or the nature of those activities. And of course, Bank of Ghana and SEC have been designated as the primary regulators based on the use cases. Now, beyond the activities in the sandbox, we have what we call which is basically exchange and trading. We have an activity called dealing service, which is literally mirroring the FX, aspect of our or FX operations framework in Ghana here. And we have custody and a whole lot of others. We have, beyond those activities, what we call the sandbox license. So this sandbox license is available or is to be utilized for any novel or any gray activities, any gray areas that are not part of the current scope of regulatable activities under the Act. And it is supposed to, it recognizes the fast changing nature of this space, and it's also supportive of innovation to make sure that the activities we have listed in the Act are not, we've not closed the page. They are not cast in stone, so to speak, but there's an opportunity for banks, not just virtual asset service providers, but for banks and even payment service providers to test their ideas that has to do with virtual asset or blockchain in the regulatory or under the sandbox license framework in the Act. And with regards to, I think I'll be speaking more on the sandbox regarding the engagement. So like I mentioned earlier, engagement has been very much integral part of our approach. So most of the frameworks we did, just like the Act itself, goes through extensive engagement with the industry. But we decided to take it a step further when we launched what we call the National Virtual Asset Literacy Initiative, in short, NAVALI. It was basically to, it has two main policy objectives. One is to enhance institutional capacity, because you are looking at the level of literacy with regard to virtual asset activities in Ghana. Though it is on an upward trajectory, the level of literacy is not really commensurate, especially when it comes to institutional capacity, regulators, law enforcement agencies, or maybe even the judiciary and other relevant bodies. And their ability to expeditiously deal with or adjudicate on these matters. I mean, they have to really have a good understanding, appreciable understanding of the space. So one objective was to enhance institutional capacity, and the other objective is to promote risk awareness in order to ensure responsible use. And I think we're also emphasizing that virtual asset is not substitutable for the national currency. So because that's one of the areas that we are paying attention. The fact that regulations are in place does not or should not be construed to mean that, for example, virtual asset or stablecoins are permitted for domestic payment or for settlement of domestic transactions. So these are some of the things that we are highlighting in the under the NAVALI framework. And of course, we are working with some knowledge partners from academia and even market operators on that particular initiative.
Thanks, Tahiru. It's a really interesting approach, and particularly in relation to the National Literacy Initiative. I know that, again, we referenced that in the chapter around the consumer protection segments and really explore the value of approaches such as that. So great to hear your insights. Jack, I wonder if we could come back to you on the point that we've touched on throughout the conversation, and you've mentioned it already as well. The NIFC is slightly uniquely positioned in the task force itself within Kenya and represents the perspectives that you've highlighted already. I wonder if you could discuss a little bit your reflections on how the NIFC has been able to engage in the process of regulatory framework maturity as it has evolved rapidly in Kenya, and particularly how those conversations have ensured competitiveness, innovation, and regulatory credibility, maintaining a balance across those areas throughout the development of the framework.
Yeah, thanks. So the NFC exists in different compartments of the law. So we are part of the team that created the Act. And then beyond that, we are part of the implementation strategy and also the National Coordination Committee that stands above that. So in terms of guiding the task force on more the competitiveness and the attracting global investment, we lead on those issues. So we're developing research on 40 plus jurisdictions, the rates, the details of how they capture different licenses, the scheduling of licenses, we lead on that. And then the security arms will lead on the AML, the anti-terrorism, and then the CBK and CMA can lead on the prudential and the macro policy guidelines. So I think our experience so far has been quite instructive because we're also the front line in terms of dealing with the industry. So we'll have global competitors coming from the US, from Singapore, from all over the globe, and giving their perspectives from their regulatory backgrounds. And so we have to take in those views, but also consider our own views, as Tahiro has mentioned, regarding our own legal tender as being superior and also protecting the local market. So that has been our experience so far, kind of acting as the bridge between the global market and also protecting the local market so that it can also develop and grow.
Great, thanks, Jack. I guess, Jonna, it would be interesting maybe to come to you at this point and just understand on the flip side of that approach, when we think about balancing competitiveness, regulatory clarity, and progression from a global market perspective, how does this clarity and coherence influence where firms may choose to invest or operate from in different markets? And specifically, how might those that are dialing in from across markets in Africa think about leveraging that approach to attract responsible innovation, promote inclusion, and ultimately strengthen long-term resilience in the virtual asset sector?
Just a small question there, Lauren. I mean, it is a huge question, and it's one that many regulators around the world are grappling with at the moment. Not just African regulators, obviously, and it's also very tied up in broader policy questions around sovereignty, around the extent to which regulators and governments want control of markets and currencies, etc. And I can see in the questions, we've had a few of these questions around capital flight and sovereignty and things like that, and why are they so important? Why do we focus on them? And that question of, to what extent, how can regulators balance the needs for, control and sovereignty, et cetera, against being open to innovation is very much one of policy and what policy outcomes you want for a given jurisdiction. And they may differ significantly from one jurisdiction to another. And digital assets, and cryptocurrencies and new forms of digital money do introduce new important dimensions and considerations. If we look at, some of the Asian jurisdictions, for example, that have been on a massive journey over the last 20 years or so, to de-dollarize their economies. Thailand, for example, has been an incredibly successful story in this instance. And this was a combination of factors. It was firstly and fundamentally improving, the macroeconomic fundamentals, strengthening trade, strengthening the country's balance sheet, etc. But it was also creating the local payments infrastructure that encouraged use of the Thai baht at greater scale, that made a more trusted Thai baht following, the improvement of macroeconomic fundamentals, more usable in the local economy. Like, how do you make it more convenient and more usable and more attractive than dollars? And they've been incredibly successful at that. We look, on the other hand, at jurisdictions who are further behind in that journey of de-dollarization, or who may have even, been on the same path, but are suddenly faced by this influx of readily available bearer instrument dollars in a digital format that can circumvent any controls, that can circumvent, currency controls, etc., as Tahu mentioned. And this poses a massive challenge. It's not just about the risk of dollarization. It's about the visibility that you have across your economy of economic activity, of where money sits, of the risk of capital flight, etc. And so I think, for every jurisdiction, this is a very individual journey. To what extent do you want to manage? Because it's very difficult to prevent that completely, but to what extent and how do you want to manage the use of dollars in the economy? To what extent do you want to disincentivize it versus incentivizing use of local currency? One of the ways that the UK is doing that, for example, is to not apply certain regulatory restrictions around, for example, financial promotions to the use of locally issued, locally regulated stable coins, as opposed to foreign issued, foreign denominated stable coins, without actually prohibiting those foreign issued, foreign denominated stable coins. So this is obviously not only a challenge that African jurisdictions face, but other policy considerations might also include the extent to which you want some of these very large multinational firms to have a significant footprint in your jurisdiction and on your economy. And if they do, the extent to which they should have an onshore presence, for example, the extent to which you want to encourage the development of local solutions, local infrastructures, etc., that may be able to, not only strengthen the local economy, but better serve local needs with their understanding of actual domestic drivers. And so it's all of those factors, all of that matrix that I think feeds into ultimately what an individual jurisdiction produces as its regulatory regime. And we don't necessarily from the outside see all the thinking that goes into that. But I'm sure, day to day, every regulator is sitting down. I'm sure you've spent, many months, if not years, thinking through these questions in the design of your framework and in trying to promote innovation, but in a way that also drives and supports broader economic policy objectives.
Great, thanks, Jonna. I'll maybe open up. That was quite a large question, and I can see we've got, as you say, quite a lot of linked questions in the chat. Does any of the other panelists want to come in on that point? Yes, Household.
Lauren, maybe here share a couple of thoughts. I think I very much agree with Jana's point about, this larger issue. I definitely see across the board. There's a lot of question about the monetary sovereignty, capital control, etc. So emphasizing the fundamentals are important. And then I think that's why before we discuss regulation, we say, there's policy choices. First, you need to have the understanding of the drivers, the use cases before you make an informed policy decisions. And then there's also other measures, both Jana and Tahiru mentioned, whether you want to secure the fiat anchor in domestic payment system, what type of uses that are allowed, right? And then beyond that, there's also holding transaction limits. So there's various tools that can also be used to mitigate some of the risks. But if I take a step back, I think a lot of the anxiety, when you look at the scale, it's so small. Some people even question, so is there a real case, for example, for the worry, or even for local currency, and Jack also mentioned that we haven't seen much of valid use cases, right? But I think a lot of the anxiety really comes from the lack of visibility and the data out there. And I also agree, in terms of the points about whether we can facilitate. I think there's a lot of private and public engagement, trying to help authorities to understand and to gain some visibility in terms of data flow. And there's a various control point like we discussed. Because if fundamentally, if we look at the stable coins, you can argue quite a lot about the monetary policy, broader macro implications. But I think a lot of the innovation is actually happening at the real level, right? Looking at the stable coin as the real, not a particular as a form of money. And of course it is, right? And that's fulfilling certain monetary functions in terms of the store of value and payment instrument. So I think with that is really about using, for example, Ghana's sandboxes, right? Bringing the both private sector and the innovators into the dialogue, and also leveraging. And for example, we also talked to blockchain intelligence companies to say, how do we trace the flow in particular specific corridors? And some of them even mark the wallet address, whether this is a merchant, this is a individual, etc., etc. So I think the whole package of things is important. And of course, there are a lot of unsettled questions, but I think we have sort of the thought process issues on the table, and then it's for a lot of the stakeholders to work together to solve those issues. Thank you.
Great, thank you. I can see Larry responding to a lot of the points as you were discussing those areas in very much agreement to the points that you highlight there, Hasong. So thank you for coming in on that. I wonder if we could just close in the final question that Wendy has raised in the chat. And Jonna, maybe you could touch on some of the global perspectives here. And Tahiru, Jack, of course, welcome you both in your markets too. Around some of the mechanisms that regulators are exploring regarding consumer recourse, especially when there are low financial literacy levels around these themes in certain markets, and the utility of such might present greater risks. Is there any reflections from the panel on that area? Are there any approaches that are arising across global markets that may be worth touching on, or initial thinking around consumer protection controls that we can consider in relation to this area?
I mean, looking at at Wendy's question, which is, what levers can regulators use to bring decentralized crypto assets into the regulatory purview? I think, first of all, in the case of stable coins, it's important to bear in mind that the type of stable coins that we're discussing are not decentralized. Obviously, the technology in which they sit is decentralized, but the stable coins themselves have a centralized issuer. And in many cases, the issuer requires, direct onboarding in order to have a contractual relationship, which may or may not, partly depending on actual practice today, partly depending on emergent regulatory frameworks, be available to all coin holders. So from that point of view, I mean, I think the question of consumer protection is a little less relevant in the context of decentralization to stablecoins. Stablecoin issuers obviously have, when they're regulated, a clear set of obligations that they need to meet in terms of backing assets that are auditable and transparency, and again, like achievable redemption mechanisms, no matter how these are structured in the market, and things like that. Now, I think that slightly adjacent to that question, but possibly where more Wendy might be after, is how stablecoins are then used and the systems in which they're then used. And some of these systems may very well be decentralized themselves. They may not have an operator, or they may be engaging in peer-to-peer activity, which is, not necessarily visible to the regulators. And for those kind of broader considerations, those broader uses and use cases and applications, that's where regulators start to consider how to implement consumer protection. Again, it's much easier when you have a clear operator of a payment system in which a stablecoin is being used, of a crypto exchange, of something else, some other type of arrangement. But when it comes to fully DeFi, decentralized finance type arrangements, then I think that's a challenge that regulators globally are trying to grapple with at the moment when it comes to consumer protection and recourse, etc. And unfortunately, there is no clear answer to that. It's a very live discussion right now, and one in which different regulators are starting to go in slightly different directions on.
Great, thanks, Jonna. I'll pause in case anybody else on the panel would like to come in on that point. Otherwise, I'm conscious that we are. Tahiru, did you want to come in with some final comments there?
Yes, just building on Jana's points around consumer protection considerations. So I think the bigger challenge is when, or it has to do with probably the lack of standards, the lack of standards or any kind of similar frameworks on offshore issuers. Because when we think through these issues, for example, what does redemption mean for a customer in Ghana who uses USDC? When the issuer is somewhere, the bank is somewhere, redemption is really, I mean, if you are designing your regulatory frameworks, I think the reality hits you that what does redemption really mean in those circumstances? Because if you are going to be extreme in terms of your regulatory requirement, you may also be obviously introducing regulatory burdens and all that. Because an entity, a stablecoin issuer, probably, even if they are even regulated in the first place, they are regulated in a certain jurisdiction. So they are regulated in that jurisdiction, and so depending on the kind of requirements that you want to impose as a domestic regulator, I think you'll be very restricted, because I cannot ask you to, for example, maintain some reserves or something. I mean, obviously, it's going to be ridiculous, right? And it's going to introduce a high level of regulatory burden on that. So I think some level of standards, at the international level will be very much useful when it comes to especially the issue of the offshore or global stablecoin arrangements.
Great, thank you so much, Tahiru. And I'm conscious that we are at time, so I suggest we maybe wrap up there, but more than happy to maybe continue this conversation in a part two, if the audience are particularly keen, as I know there were many questions that we didn't get a chance to cover. As mentioned, we will be hosting a follow-on discussion to celebrate the launch of the conversation and the publication more broadly at the 3i Summit next week in Ghana. So for those that are attending that summit, please do say hello and let us know, and we'd be happy to also continue the conversation there. But a huge thank you to all of our panel speakers today. It's been a really fantastic conversation and just really highlights the complexity of the exploration of these principles in global markets, and importantly in the diverse markets that we see across the continent. We will be following up with a link to the recording, and we will also be following up with further information on the paper itself in the next week. So we look forward to hearing everybody's reflections on that discussion. And as mentioned, we are happy to do a part 2 if there are particular follow-on discussions once the paper is live as well. So just a huge thank you to everybody that has made the time to dial in, and especially a huge thank you to those that have joined us on the panel today to share their insights. We're really excited to hear the reflections on the paper once that's live, and look forward to continuing this conversation over the various forums in the coming months. Thanks, everyone, and speak soon. Bye.
Thank you.
Thank
Bye-bye.
you.
Thank you.
Thank you.
Bye.